Hello and welcome to today's webinar. My name is Danny and I'm with the learning team at Cherry Beckert. We're going to go over a few quick housekeeping items before we get started today. For audio during today's webinar, you may listen through the phone or the computer speakers. You can choose your audio under the audio tab in the menu to the right of your screen. To earn CPE for today's webinar, please make sure that you answer all the polling questions. Make sure to click the submit button to submit your answer. Instructors will try to remind you of this as each poll appears. We will be issuing CPE for participation in today's webinar in the coming weeks. The instructors and I will answer questions in the question and answer pod. We will try to answer them throughout the webinar. Lastly, at the end of the webinar, you will get an evaluation via email. Please complete the course evaluation when you have the chance. So that's all for today's housekeeping announcements, and here are our instructors.
Hello, everyone. Thank you for joining us. We're excited about being here on December the 1st to talk about things that we can still do to make 2020 a good year, if not for pandemic reasons, at least for tax planning purposes. So with me today, I'm Sarah McGregor. I'm a director here in our work with our federal tax group. Mike Kirkman is a partner, a tax partner, and is our national leader for our estate, gift, and trust services. And John Urey is a principal. He also works with our high net worth individuals and does a great deal of work with our estate and trust group as well. So we're excited to be with you today and talk about year-end planning. This is our usual housekeeping announcement. Just make sure that you know that this is an overview of positions and developments and ideas. So please make sure that you talk with your tax advisor about your particular facts before you act on any of the items that we'll be talking about today. So let's start talking about tax planning. Well, you can't really talk about tax planning without knowing what the factors are. And the most important is, what are the tax rates that apply? These are the 2020 individual income tax rates. And as you can see, they start at 10% and roll up to now the highest maximum rate is 37% for individuals. And that kicks in for married filers at $622,000 and for single filers over $518,400. So pretty high levels. You can see there that the 35% bracket covers a wide range of income levels. The 24% bracket covers a wide range of income levels, and the others are a bit narrower in their scope. But it helps to know where you fall so you understand what each additional amount of income or each additional deduction may cost you or save you as we work through planning ideas. The other important tax rate to know for individuals is, what is the capital gains rate, and what applies to long-term capital gains and to qualified dividends. For single individuals, it's from zero tax rate, from 0 to 40,000. For the 15% rate, kicks in from 40,000 to 441,000. And for married individuals, it's pretty much double those numbers. Starts at 80,000 for the 15% rate and runs up to 496,000. And then you can see where the 20% bracket kicks in for capital gains and qualified dividends above that. That's not tied to the income tax brackets from the previous page. So the 20% rate will kick in before someone gets to that 37% maximum ordinary income rate. A couple of other key figures to remember for 2020 is the standard deduction. For joint tax filers, it's going to be $24,800. For a single filer, half that at $12,400. And for those age 65 or blind, there's an extra $1,650 for single filers and $1,300 for each of the married individuals. The credits for the child tax credit really did not change for 2020. It's the same as it was in 2019. It's $2,000 per child, and there is a refundable portion up to $1,400. And as you recall, the Tax Cuts and Jobs Act changed the phase-out range for this to make it much easier for more taxpayers to qualify for this child tax credit. And since we lost the exemptions, the personal exemptions, there is also a $500 credit for other dependents. This could be parents, it could be aunts and uncles, it could be brothers and sisters, it could be some other who is not a child in the family, but part of the family household. All right, we've covered some of the basic numbers we need to keep in mind. So let's move on to planning itself. Well, who should plan at year end? Certainly those in the highest tax brackets should take planning into account because they get the most bang for each dollar of savings that they can make. That's 32, 35, or 37 cents on each additional deduction or each reduction in income, each dollar of reduction in income. Owners of closely held businesses have an opportunity to take advantage and flexibility where they control much more about their source of, may control much more of their income coming in and can take some business deductions. Taxpayers with life changes, that is those whose life circumstances and tax filing circumstances may have changed. They're married now or they're divorced now, and something significant changed to their income. Perhaps they retired, perhaps they had a lump sum, perhaps they changed jobs in the middle of the year, or there's additional children in the household, or maybe some children left the household at this time. And other significant transactions, perhaps you inherited a large amount of money, so now your investment income is greater than it has been in the past. Perhaps your business was severely impacted this year by the coronavirus and the impact of the pandemic, either successfully or negatively. So when we start talking about tax planning, we need to gather some basic information, and this is helpful for you to be thinking about. Number one, how much have you earned and how much taxes have already been taken out, and what has already happened? Have you already made charitable contributions this year, had significant medical expenses? Will your income change in 2021? We talked about retirement. Perhaps you won't have those large bonuses next year that you earned this year. Are you subject to some special tax provisions such as the net investment income tax or the alternative minimum tax that we also need to take into account in planning? How much flexibility do you have to take additional capital gains or losses or make additional contributions? And are you interested in making gifts or contributions to 529 plans or ABLE accounts? And of course, do you have a pass-through business or a closely held business? And then there's some special questions for 2020 we need to be thinking about. One is, how has the coronavirus impacted you individually this year? Were you furloughed for a period of time? Did you lose some money? Did you make more money? Did you receive one of the CARES Act stimulus payments? And how much did you receive? There may have been some other transactions. We know that there are a number of business deals and property location deals that are happening very fast here in this last month of the year. So there may be some significant transactions that have taken place or may be taking place to close out. And then what is your outlook for 2021? And how do you think the election results will impact your taxes in 2021? Because we need to take those things into account too when you talk about planning. You have a copy of these slides in the handouts pod if you want to download them, but this is just a real quick checklist of the kinds of things we're looking for when we start talking about year-end tax planning. How do we defer income? How can we accelerate deductions? That's the traditional model for year-end planning, is to push out income into the next year and take as many deductions now to lower the tax this year. Then we'll worry about lowering taxes in 2021 when we get there, and we'll take action steps in that year. Can you manage your losses and gains so that they can offset one another? Do you have enough basis to take losses that may be passing through from your pass-through entities, your S corporations, and your partnerships? And have we thought about how the classification of various types of income will affect your bottom line and planning for your 2020 taxes? A couple of other things here. Credits are becoming more important. State tax credits, a number of federal tax credits for incentives to do certain things, whether that's in a small business hiring the right people, whether it is installing solar energy on the building, whether it is working on restoring a historic building and preserving that, and creating credits from those opportunities. Credits, and whether those are state credits or federal credits, credits are becoming a much more important play in everyone's arsenal of tax planning opportunities. And the whole idea behind this is so that we figure out how much the tax needs to be paid in by the fourth quarter payment, which is January 15. And then also, what do we know about the cash call that's going to come due at April 15th? And we want to eliminate any surprises when it comes to that and plan and manage ahead. So if you're going to owe money, you have time to accumulate that cash over the next 4 or 5 months and to be ready for April 15th when it gets here. All right, so one of the first items on that checklist was about deferring income and accelerating deductions. Well, what do we mean when we talk about those activities? Well, for individuals, if it's possible, defer compensation into the next year, particularly bonuses. If you have the opportunity to move those bonuses out into 2021, then that takes that income out of 2020. Maximizing those pre-tax retirement plan contributions, putting that money into 401ks, into profit sharing plans, into IRAs, tax deductible IRAs. Looking to, if you're selling property or selling assets, can that be done if there's a gain on an installment sale basis, or even engaging in a like-kind exchange? And we'll also talk about the opportunities for a qualified opportunity fund as a way to also defer gain. Think about how to reinvest those funds that you might receive in a sale of assets. Do you want to put it into non-dividend paying stocks so that you can control when you recognize income? It won't be currently recognized, but it'll be recognized when you dispose of that stock at some later time. Do you want to consider tax exempt investments and what that could mean? We'll talk about several opportunities for changing up what happens on distributions from retirement plans here in 2020. And for those that have stock options available, consider when is the right time to exercise those. The other way we can help our tax situation is by managing the classification of income, moving more towards capital gain type income and away from ordinary income type income. So that includes investing in things that stocks that throw off qualified dividends. That means holding on to investments for the 1-year holding period to get that lower rate. It means also managing our losses and gains to offset each other. And when it comes to whether something is an investment asset and going to get that capital gain treatment, or is it an ordinary income asset, or is it a personal use asset, very important to manage that classification. Something like rental property or vacation homes come to mind, or if you collect automobiles or other things that can be considered an investment or might be held for personal use, or could be used in a trade or business, such as a rental activity. It's important for us to understand the distinction between how you consider that piece of property, what's your intent in your actual use when it comes to ownership of particular assets, to define the kind of income that's going to come from that. And so I think, Danny, we're up to our very first polling question. If you want to go ahead and load that in. All right, so who should engage in tax planning at year end? Owners of closely held businesses, taxpayers with life changes during the year, A or B, or not sure. Okay, we'll give you a moment or two to answer this first question. It looks like many of you are voted in. All right. Okay, one more, we'll give you about another 10 seconds and share the poll results on this one. Okay, yes, A and B, great answer. Those are excellent opportunities for moving forward. Okay, so there were a number of changes this year, both from the Secure Act that was passed at the end of December, and also the CARES Act that was passed in March, that brought changes to how folks interact with their IRAs and defined contribution plans, both from the distribution side and the contribution side. So we kind of want to walk through that so that you can get a feel for how this looks. So for 2020 only, just this year, the 10% penalty for taking out early withdrawals from the plan does not apply if you're taking out a coronavirus related distribution. And that distribution can be up to $100,000. And the advantage of taking a coronavirus related distribution is that you have 3 years to either repay the money back into the plan or roll it into an IRA. If you took it out of, say, your company's 401k plan, and over the next 3 years, you can roll that into an IRA or back into the company's 401k plan, or you can pay tax on that income over the 3-year period. So what exactly is a coronavirus related distribution? Well, it's for people who are directly in their families diagnosed with coronavirus, with the COVID-19 virus, or someone who has suffered adverse financial consequences, that is from being quarantined, furloughed, laid off, or unable to work, a closing or reduced hours of a business. And there are a number of other reasons identified in Notice 2020-50. So pretty much if you suffered a pay cut, you suffered hours being cut, your business was affected, you as an employee were affected, you're going to be eligible for this coronavirus related distribution. And why do I raise this if you didn't really need the cash? Well, it's one way to move money out of a 401k if it's getting rather large and you want an opportunity to invest through an IRA in something slightly different, but you're still working, you're still in service. This is a way to take an in-service distribution, if you will, to move that money over to another vehicle that you can use to invest differently on that. So that deals with the coronavirus related distributions, only effective for 2020. The other thing that happened this year was that the required minimum distributions for 2020 were also suspended, so that IRAs and defined contribution plans, the plan participants and plan beneficiaries are not required to have the required minimum distributions, those RMDs, distributed to them this year. And there was an opportunity if there were distributions early in the year when this law came through with the CARES Act, that taxpayers were given the opportunity to put the money back all the way up until August, or to roll over into another IRA or 401k to put their money back and not have that. I do make note of this, that a lot of people, we've had a number of questions about, hey, if there's no RMD for 2020, can I still make charitable contributions from my IRA? And that answer is yes. Individuals can still make distributions, qualified charitable distributions from their IRAs this year. Okay, a couple more things that came out with the Secure Act early in the year. One item is that they raised the age limit from 70 and a half to age 72 to begin taking those required minimum distributions. But if you were already 70 and a half at the start of 2020, you were stuck with the old rules. So it's only for those who had not yet turned 70 and a half at January 1 of 2020. Another planning idea is to think about now whether or not to convert a traditional IRA to a Roth IRA. Now, generally that means that there's going to be a tax consequence right now for that rollover from the conversion from a traditional to a Roth, but this may be a low tax year for you if there are other losses going on. If you anticipate that tax rates may increase in future years, and tax rates right now are lower for you than they might be in the future, that's another opportunity to consider moving to a Roth, because distributions from a Roth are not taxable. The third is that there is no required minimum distribution out of a Roth IRA, so you could leave that for your children or grandchildren if you wanted to, and are not required to take money out of a Roth. And the earnings in the Roth are tax-free as you go along as well. And then if we're looking at someone who is underpaid on their taxes, this is one way to take a distribution and then have tax withheld and then roll that over into a new plan, a way to help individuals avoid penalties for underpayment of tax that they hadn't anticipated. Health savings accounts bring a triple tax advantage for those that can participate in high deductible health plan, or HDHP, high deductible health plan. So a health savings account, the earnings on contributions, the contributions into a health savings account are tax deductible. The earnings while the funds are in the HSA are free from tax. And then to the extent that distributions are made out of this HSA for qualified expenses, that too is tax free at that time. So a really nice triple benefit element to these plans. If you have one, you want to make sure that you are putting the maximum allowed into the health savings account. Okay, so we've talked about some income management, how to defer some income items. Let's talk about some deductions. And there's just a few here that I want to highlight. One we mentioned was to maximize your contributions to your IRA, profit sharing, retirement savings plans, and maximize your contributions to your HSA accounts, the health savings accounts, and manage those flexible spending accounts. Let's not leave money on the table in those accounts and use those accordingly. Another piece of good news from the CARES Act was that it modified Section 461L, which was brought in with the Tax Cuts and Jobs Act. And I like to refer to this section as one that sort of taps the brakes on business losses and how much can be allowed in a particular year. It limits that amount of business loss that can be allowed, but fortunately, the CARES Act removed that limitation on a temporary basis. For business losses, for farm losses, it has been removed effectively permanently. But for business losses in 2020, here is a year where you can take all of your losses, and it's still an opportunity for us to carry losses back to prior years, 5 years back, to free up taxes. So now is a great time. If you have control over a closely held business, you have a Schedule C business and can generate more losses in 2020, there's no limitation on those. For 461L, and there may also be an opportunity to carry that loss back up to 5 years to free up taxes previously paid. Section 199A, this is the qualified business income deduction. It's for pass-through businesses. On when you receive income from those pass-through businesses, this is the 20% haircut, if you will. We want to make sure that we maximize this deduction, and it could involve some concerns about making sure that you actually have a trader business for 2020. Has there been enough activity going on for your business this year? Consider where those phase-out rules start to apply, and make sure that if there's an opportunity to stay under a phase-out, that we can do that to maximize that 20% deduction. And look back over any of our elections we made to aggregate business together, or consideration of the 250-hour rule for rental operations, that safe harbor. We want to make sure that all the records are in place now, rather than trying to recreate them come April or even next August or September or October. Now is a much better time to get that documentation in place than it did. And for those that have a trader business, consider the need to file forms 1099, and that may be the 1099 miscellaneous or now the new 1099 non-employee compensation or NEC form that may be necessary to stake out that this really is a good business. Another way to push off gains is to consider the qualified opportunity zone. Investments, and this is where taxpayers who have a capital gain can defer that gain by investing into a qualified opportunity zone fund, which invests into projects in a qualified opportunity zone. So businesses, buildings, activity in a qualified opportunity zone. And there's two advantages now that will help. One is deferring paying tax on that gain until the end of 2026. And the second is that if the funds are in this qualified opportunity zone fund invested for at least 5 years, then you can reduce the gain that will generate tax at the end of 2026 by 10%. So a reduction in the gain that you have to pay tax on by 10%, as well as a chance to defer out paying that gain, a tax on that gain for at least 5 years. And the third opportunity is if the funds remain invested for a full 10 years, then there's an opportunity to avoid or paying tax on the gains earned from 2026 until the asset is disposed at the end of that 10-year plus period. This is just a quick slide talking about the different kinds of gains that do qualify for participation in a qualified opportunity zone fund and those that do not. Okay, so we've talked about things which we refer to as above the line. That is really page 1 of your tax returns. And now we're going to talk more about below the line or the itemized deductions side. And we usually think that most itemized deductions, there's not a lot of opportunity here, but there really are some things to think about. And that is looking at our discretionary expenditures, contributions, medical expenses, maybe a little bit of interest expense that we could budget between year 1 and year 2. You could consider using your credit card if you don't have cash right now or don't want to use cash right now. You could still make payments with your credit card here in 2020 that will count, and make sure that we're using as much of that $10,000 SALT cap as allowed. Couple of new things to note. The medical expense limit floor has been retained at 7.5% of AGI, goes up in 2021 to 10%, but it's at 7.5% again for this year. Still no miscellaneous itemized deductions allowed. All of those things that we used to deduct, those are not allowed. Pretty much personal casualty losses are not allowed, except in very dire circumstances, and we certainly have had those with the hurricanes and the wildfires and the flooding and other disasters that have happened this year. Certainly we have had personal casualty losses that could qualify. But there are a couple of new things I wanted to point out on the charitable contributions section. One is that they've raised for 2020 the threshold to allow deductions up to 100% of your adjusted gross income. For those individuals that have maybe some losses this year, so AGI is down, their adjusted gross income is down, or they're extraordinarily charitably minded and they want to give lots this year, the threshold has been raised up to 100%, so you can offset all of your adjusted gross income with charitable contributions this year. Secondly, for those that use the standard deduction, there is an above the line $300 deduction that can be used. And that is new and one time only. It is a $300 cash contribution to a public charity. It could be a church, it could be Red Cross, it could be the local pet shelter. It could be anything as long as it is a public charity, and can receive that. And you'll get not only the standard deduction, but also this extra $300. So we talk about a bunching strategy for itemized deductions, and I just want to give you a simple explanation as to, or example as to how that works. So here we have taxpayers that are married, filing a joint return, and they live in Florida, so we're not going to deal with state taxes. And they generally have what these state and local taxes of $7,000 is probably property taxes, mortgage interest of $4,000, and contributions of $15,000. So their annual their annual itemized deductions are about $26,000. And with that, they would have total deductions over the 2 years of $52,000. And that $26,000 exceeds the standard deduction each year, so they would want to take the itemized deductions. Now, but what if they were to bunch those contributions and take 2 years worth of contributions into 2020 and then none in 2021? So in this case, we would take an extra $15,000 of contributions, which would get our total itemized deductions up to $41,000 in 2020. And now we only have just the state and local tax and the mortgage interest in 2021. So we would want to claim the standard deduction instead. And so by doing that, our total deductions over the 2 years is $65,800. So that's the idea behind the bunching strategy of moving contributions or moving medical expenses, or maybe even a little bit of mortgage interest payments between one year or the other, or maybe property taxes from year to year in order to bunch up those expenses in 1 year to take a large itemized deduction, and then in the next year, take the standard deduction. We do get a lot of questions this year about home office deductions. Home office deductions are, because so many people are working at home during the pandemic, the space has to be regularly and exclusively used for operating the business. It has got to be your principal place of business, the place to meet and deal with clients and customers. And if it's a separate structure of the residence, it has to be used in connection with the businesses. Now, if you're an employee, you can qualify to have a home office. However, that home office expenses are deducted as miscellaneous itemized deductions. And if you'll remember, we're not allowed to have any miscellaneous itemized deductions under the Tax Cuts and Jobs Act. So it really doesn't help. But for people who are non-employees, in other words, they are running their own businesses, they are partners or they are owners of the business, then they can report those home office expense deductions on Schedule C, E, or F as appropriate. So I suggest if you're an employee, I'm sorry, this is not a great answer, but if you're not an employee, that is, you're a business owner, then there may be an opportunity here as long as the space is used regularly and exclusively just for operating in your business. So the dining room table won't work, but if you have a dedicated office space, even if it's just a part of a room, can qualify. And there's a publication there, IRS publication 587 has a lot of information about that. Okay, as we get close to closing down this, one other area to think about is for those of you that have trusts where you have some flexibility of taking distributions from the trust, the top tax rate for a trust income kicks into 37% only at income over $13,000. So if you remember, the top tax bracket for the 37% for single filer is $518,000 and kicks in at $622,000. So if you are a beneficiary of that trust and can take that income and report it to yourself on your own return, you could very likely be in a lower tax bracket than if the trust retained that income, paid tax on it itself at the highest tax rate at 37%. So something to think about if you have some control and can influence and provide some conversation to the trustee about distributing the 2020 income to you for you to pay tax on. It may help the overall family wealth for you to do that. And two, in the same way that the top tax bracket is reached very early, then also the same is true for net investment income tax. And finally, just one last thought here as we talk about individual tax planning, and that is making sure that your year-to-date withholding and estimated tax payments are reviewed and considered, particularly if you were counting on or have considered in the past any withholding on an IRA or pension plan distribution as part of your withholding. Then you, without the requirement to take an RMD this year, you might not also have that withholding. So you'll want to take that into account in considering if that impacts your 2020 tax planning. All right, Danny, that brings us up to polling question number 2. Talk about a bunching strategy. So a bunching strategy can increase total deductions by claiming the standard deduction twice, double deducting itemized deductions, or paying 2 years worth of contributions in one tax year. Give us an answer on that one. And we've got just another minute, and then we'll get on to estates and gift planning. All right, we'll give you about another 10 seconds, and then you want to go ahead and get your second polling question answered, for those of you that are still out there. All right, let's go ahead and the answer to that, yes. Bunching those contributions, doubling up on your contributions into 1 year so you can take advantage of the standard deduction the next year is how the bunching strategy works. All right, thank you. So let's turn it over now to Mike and John to talk about estates and gifts planning.
Thanks, Sarah. I appreciate it. So why now? Obviously, the pandemic has impacted many different types of businesses, and some of them in a very positive way and some in a very negative way from a valuation standpoint. There's a lot of opportunities right now with the exemption amount, which we'll go through in just a minute, it being at the all-time high level. So you've got depressed values that potentially can lead to planning opportunities to move that value out of one's estate so that when it does rebound, all that rebound is captured outside of the individual's estate. Also, low interest rates. There's a number of transactions that we'll go through a couple examples that when you are dealing with family strategies from an estate planning standpoint, that these applicable federal rates can be very significant in a positive way because of they're at an all-time low. So you can see the short term is 1 to 3 years, then longer than 3 years, shorter than 6 years, and then over 9 years, you've got the long-term rate. So these are, especially when you're dealing with family situations, personal loans to kids, sales transactions, which John and I will speak to a little bit more later. These are far better than any rate that you can get at a commercial bank. So what is the wealth transfer amounts? Right now you can see they're getting ready to go to 11,700,000. That's per U.S. resident, per U.S. citizen. So a married couple is going to have over $23 million to make transfers during their lifetime or at their passing. Now, in light of all the politics that have been going on, whether you're on the left or the right or in the middle somewhere, there is a lot of talk that the Biden administration, and he's put it into some of his tax policy commentary, that he would like to see the exemption amount dropped to as low as 3.5 million. That's why right now there is a lot of activity in this area of folks moving closely held businesses, not only that they get some discounts on valuations, but they're getting to utilize this exemption amount that may revert back to a much lower number. And the annual gift tax, this is the present interest gift. You give your kids $15,000 every year. A husband and wife can make a $30,000 gift and not impact their exclusion amount each year. And that amount is staying at 15 going into 2021. So with that, John's going to talk about some strategies that to be thinking about now and going into 2021.
Thanks, Mike. Hello, everyone. As Mike mentioned, right now we kind of have a perfect storm with a lot of these gifting strategies. As he mentioned, we have our lifetime exclusion, highest it's ever been. In 2021, it goes up another $120,000. Have some clients that are already maxed out, so beginning in January, they can make additional gifts and continue to max out their total lifetime exclusion amount. And it's also, Mike mentioned, it was going to expire at the end of 2025 anyway. Now that might be truncated. We might see that end sooner than that because of the political landscape we find ourselves in. So it's better to act now and be able to make those savings. The IRS has already told us there'll be no clawback. So if we give over, like say the Biden administration knocks it back down to 3.5 million. If we have clients that have gifted 11.7 million, there's no clawback. They're not going to come back and tax what they've already gifted. So it's an opportunity to take advantage now. Annual exclusion amount. Every U.S. citizen can give $15,000 per person to anyone. You can go through the phone book and give $15,000 every person and not have it be taxed for gift purposes. So every couple, that's $30,000 to give. Opportunities now to do that in December and then potentially do that again in January without impacting your estate tax exclusion amount or any of your estate planning. With this, we want to review the client's goals. What are their goals now? What are their goals in the future? These always change as we're doing year-end planning. It's a good time to go over with, a lot of times we're dealing with the matriarch and the patriarch and talk about what's happening in their family. Have there been marriages or divorces? Do any of the children have, are there addictions? Are there other kinds of disabilities that we want to plan for? Clients love talking about this. Generally, they want this kind of in-depth planning. And that's what it really takes now to service clients, is this tailored, granular planning based on their needs and their specific circumstances. One of the biggest, don't want to say loopholes, opportunities right now that we have in the estate planning area is carryover basis and step-up in basis when someone passes away. So we want to make sure that we're planning around these issues, especially while they're still available to us. Again, Biden administration has indicated that they maybe go after the step-up in basis, and so we want to use that while we can. So carryover basis, as we know, when a donor gifts to a donee, that basis is carried over to the donee, and they use that for their basis going forward. So when we're gifting, we want to consider outright gifts. We want to use minor accounts when necessary when we're gifting to minors. We want to understand how low basis assets impact the tax situation for the donor versus the donee. If the donee is in a larger tax bracket, they'll pay tax on that. Whereas if we gift low basis assets to a donee in the lower tax bracket, they may not pay any capital gains. So maybe in the zero capital gains tax bracket, and we can save holistically on the tax burden there. We want to remember as well, if a donor makes payments directly to an educational institution or medical institution for tuition or medical expenses, those are excluded for gift tax purposes. So we can give $15,000 in cash to each child, and we can also pay that child's medical bills and tuition directly to those institutions, and we still don't have any reportable gift tax that we have to worry about. Also, we can front load 529 plans up to 5 years worth. and ABLE accounts, which are for disabled individuals. So a single person can gift $75,000 to their child or to someone and put it in a 529 plan. Front row those 15-year annual exclusions amount for 5 years. Get it out of the way right now and not have to worry about it in the future. Wanted to spend just a quick minute on what we call SLATs, or spousal lifetime access trusts. These have become more popular lately, especially with our kind of middle range wealthy clients that maybe have around $20 million. And again, not $20 million is a lot of money, but for a lot of our clients, we have some that are, are $50 or $70 million or $100 million. But down low around the $20 million range, these clients don't want to gift it all away. They don't want to use that $23 million that Mike was talking about for their estate tax exclusion amount because they need it to live. So what has become more popular is for each spouse to set up a trust for the other spouse, and we gift assets to those trusts. Those trusts support the other spouse during their lifetime, and then it goes to the children typically. And that way we can still have some control over the assets. We can still use the assets. We can get the income from them, but we don't lose complete control. For these types of trusts, they're in vivos, they're irrevocable. The grantor spouse is one of the beneficiaries. As I mentioned, children are usually the other beneficiaries there. Similar to a credit shelter trust, if you're familiar with that concept. But instead of happening at death, this happens during their lifetime. This provides the income to the spouse at life, and then the principal and the appreciation moves on to the next generation. The spouse can be discretionary beneficiary for both income and principal, so they're not necessarily limited to just the income. And this is a grantor trust, so the income is taxed to the grantor and not necessarily to the spouse if it has not been distributed. There's a lot more that goes into these trusts, but this is a quick overview. They're very popular and they can be very powerful from an estate tax planning perspective and from a wealth preservation perspective. Another thing that Mike mentioned that we're seeing now is being able to leverage the current market situation with the gifting potential. And this includes moving marketable securities to the next generation. So we're leveraging the gift tax exclusion with low valued assets right now. These can be publicly traded assets, or they can also just be closely held business assets. We've seen a lot of our clients, their businesses have depreciated in value. Maybe they've lost some business or things have happening. A great time right now to pass some of that ownership over to the next generation. Again, we can use a spousal lifetime access trust for this, and any return of future value will be removed from the donor's estate and passed on to the next generation. Business valuation, great time for doing this because of the current market situation. We can use this to, Cherry Becker, we have our own team, does a great job. We can get this done quickly and save the taxpayer a lot of estate and gift tax headache down the road, potentially a lot of tax liability because the values we can take a discount for marketability, discount for control, and they're potentially already discounted because of the market and the way things are going right now. We can gift a tremendous amount of value to the next generation for a relatively low amount of gift tax exemption amount.
So with that, I'll just mention a strategy that comes into play quite frequently when you have individuals or family groups that have closely held businesses and they have maybe used up a large piece of their $11,580,000 exemption exclusion amount. So, and then they go, well, I still have this other asset, and how do I don't want to I don't want to sell it. We're going to keep it in the family, but how do I remove it from continuing to appreciate and have all that appreciation taxed in my estate? Well, there's a sale to a grantor trust, and the grantor trust is an irrevocable trust that has certain language that for IRS purposes and income tax purposes is disregarded. It's as if it doesn't exist. So the owner of a closely held business sells this interest to this grantor trust, and there's no gain or loss recognized on that transaction. There's also no basis step up. But what you're doing is you're putting a note in the grantor or the owner, the former owner's hand. Well, that note is not going to go up in value. So it's a frozen strategy that freezes the asset for estate tax purposes. And so if this asset, the business that's now in this trust for the benefit of a spouse or the kids or future generations, that value that goes up over time is completely out of the original owner's estate. So that's a classic freeze. These transactions, we do them all the time. They happen quite frequently. They're not for everybody, but when you do need that extra leverage to get an asset that's appreciating in value out of your estate, this is a great technique to use. And a couple of examples of that, just look at this briefly. If we did a sale to a SLAT, again, there's no gain or loss, but if we did a $10 million sale to a SLAT and it grows over 3% and 7%, I mean, the math is undeniable. It works. And the other thing that we did not mention about a SLAT, one of the attributes is that the asset protection. So the family members that are beneficiaries of this trust are shielded with a lot of asset protection because of the language that's put in the trust. Another real popular strategy is grantor retained annuity trust. So essentially, the grantor is making a transfer to a trust, but for purposes of a term of year, whether it's 10 years, 5 years, whatever the term may be, they are retaining the ability to draw an annuity stream back from that trust. So if we just used $1 million of marketable securities, you could use $1 million of closely held stock. So the gift is not $1 million. The gift is $1 million less the value of whatever that retained interest is. So in this example here, we're zeroing out the gift. We're making on the remainder interest. Mathematically, we're making it zero. So in this particular example, if the donor or the grantor retained a 50.5996% annuity stream for 2 years, there's effectively on that $1 million transfer, there is no gift on that. So with the AFR being as low as it is at 0.8%, if that asset that's in that trust beats that 0.8% growth, you will have removed anything over that growth out of the person's estate. So if the asset happens to grow 20%, this is the amount of money that would be completely removed out of the individual's estate. And you can see if we're talking just $1 million here, if we were talking about a $10 million asset or $20 million asset, the numbers can get quite staggering. And I'll turn it back over to John.
Yeah, another strategy that we can employ is for the grantor to sell assets to an irrevocable grantor trust and take back an installment note. And what we do with these notes is we make them self-canceling. This is called a SKIN or SEIN. And these can be powerful tools to transfer value to the next generation, because if the seller, if the grantor, if he dies during the note's term, the buyer, the trust, is relieved of any future payments. And so it's a great way to transfer that value. The gain does have to be picked up on the estate's income tax return on a Form 1041, but it transfers that value. Now we have to be careful. We have to, like a lot of things in estate planning, we have to balance this. The purchase price has to be at a premium and at a higher, potentially at a higher interest rate to make it for the risk of dying during the term. And so the tax benefits would be lost if the grantor lives longer than he's expected to, he or she are expected to, because then the buyers will have paid a premium. The buyer here is the trust and the estate, the grantor's estate, will be larger than it was before. So we want to make sure we balance this, but potentially this can be a powerful tool as long as we can, be fairly sure that the grantor would not outlive the installment notes term.
All right, Danny, I think that brings us up to polling question number 3. What is the annual gift exclusion amount in 2020? A, 15,000 per donee, 15,000 total for all donees, 14,000 per donee, or not sure. I'll let you guys take a crack at that. Good. I hope we've made the question straightforward enough to give everyone a chance to feel very successful today on answering polling questions. I'll give you just another 10, 15 seconds or so to answer the poll question to make sure that you are getting your CPE credit for today. All right. And yes, the answer is $15,000 per donee. So great.
Thanks, Sarah. We want to talk quickly about grantor trusts. Mike mentioned using these grantor trusts for different things. Another strategy we can employ is making sure that we have the right assets in these trusts. One of the aspects that make a grantor trust is the ability to swap assets. We can, as long as it's the same value, we can put whatever asset we want into it and pull whatever assets we want out of it, without any transfer tax, without any tax on the transfer. And so what we would typically want to do is make sure that the assets going into the trust have the highest likelihood of appreciation, and that way future appreciation is therefore out of the grantor's estate and will not be taxed. It results in a higher tax-free transfer when results in a tax-free transfer of the potential higher value when the assets begin to appreciate, so we can pass it on to the next generation without having to worry about. Another strategy is swap out low basis assets with high basis assets, because if we can put the low basis assets back into the grantor's name, if they're potentially going to pass away soon, then those low basis assets will get a step up at the grantor's death. And we don't want those in the trust. We want to get the step up if possible. And so if you have a client that is not doing too well, that's another strategy we want to take a look at for 2021 to see if we need to swap out any of those assets to take advantage of the step up in basis.
And just a comment on GST, generation skipping tax, and basically that is any type of gift transaction or gifting that involves not the first generation. So for gifts to grandchildren or great-great-grandchildren, even if it's in trust, there is a GST allocation, and that the allocation exclusion amount for GST transfers is the same amount for regular gift tax purposes. So in 2020, many times there folks have been making gifts to GST trust. There are rules that apply to allocating that GST to that gift, and the consideration here would be that if the value of that gift has significantly dropped since the time it was funded in the trust, consideration of making a late GST allocation will allow you to use less of that exclusion of 11 million, soon to be 11,700,000 for GST purposes. And again, it's two different types of tax. There's gift tax and then GST tax as well. And as Sarah mentioned, the changes to the IRA payout rules are now limited to 10 years. I would just say that if you've got some clients that would like to learn strategies about extending that payout, there are ways involving charitable remainder trust that can help stretch that IRA out so it's not taxed over just a 10-year period. And I will pass it over to John to do some concluding remarks.
Thanks, Mike. I'll just highlight a few things quickly and then pass it on back to Mike just to wrap up with his thoughts. One thing we wanted to highlight here is this asset protection that Mike mentioned around these trusts. It's a big deal. Even if we don't get any tax savings from it, we recommend it very strongly because it protects against lawsuits, malpractice, divorce, creditors, and other potential people who want to come in and take that value away. We want to ensure that the assets are transferred in accordance with the client's wishes. Updating that every year and making sure that we understand and that they understand what's happening with their estate plan is very important. Want to shift future asset growth and income. Best way to do that is to understand what their assets are and how they're titled and what the expectation is for that potential growth in the future. Charitable giving with trusts and outright requests. A lot of our clients do this for tax purposes and philanthropic reasons. We want to make sure we understand that and help them take the best advantage of that as we can. As some of us know, there are ways where a trust can be giving charitable contributions that are not deductible if it's not done right. So we want to make sure that that is handled appropriately. And then control the assets distributed to subsequent generations, protected, as we mentioned, spendthrift addiction, and make sure that they're incentivized to be productive members of society in the future. Special needs, that's a whole different planning aspect. We want to be able to provide for them, but also have them take advantage of any potential government benefits that they would be eligible for. So the planning around that needs to be very specific as well.
All right, Danny, if you'll put up the last of the polling questions, and Mike, I'll let you make any last comments about planning here in 2020 and the things you've been seeing.
Yeah, like I mentioned before, the concern of the 11,580,000 exemption amount going dramatically lower to potentially 3.5 has caused a lot of folks to make decisions with regard to wealth transfers. It's going to continue. And I would just say, even without a valuation, that because we've got a month and our valuation team is extremely busy, but even if you can't get the valuation secured and finalized until 2021, there are ways to effectuate a transfer by using things like a defined value clause as part of the transfer. So you can actually move the wealth in 2020 and get the valuation finalized and sort of fill in the blanks, say in February or March when the valuation is finalized. There's some maneuvering that you've got to do around that, but we're seeing a number of that. But there's one thing for sure, tax law always changes, and sometimes it's taxpayer favorable and sometimes it's not. We can't predict the future, but I'm pretty confident that we're going to see some dramatic changes going forward.
All right, great, thank you. And so, well, appreciate that when we look at the last poll there, that many of you are engaged in tax planning and already are getting ready to and are continuing to have conversations with your tax advisors. We certainly appreciate that. We appreciate your time today. And if you have any questions at all, please reach out to Mike or John or myself, and we'll be happy to help you or your Cherry Becker tax advisor. So thank you and have a good afternoon.